How did the AIG bailout impact the Great Recession? Imagine a giant insurance company holding the fate of the financial world in its hands. That was American International Group, or AIG, during the financial crisis. AIG was deeply involved in insuring risky financial products called credit default swaps. These swaps were supposed to protect investors if loans defaulted, but AIG didn't have enough money set aside to cover potential losses. When the housing market collapsed, AIG faced huge losses, more than $99 billion in 2008 alone. This put the entire financial system at risk because many big banks and investors depended on AIG's insurance contracts. When Lehman Brothers, a major investment bank, was allowed to fail in September 2008, it sent shockwaves through the markets. Policymakers quickly realized that AIG was too big to fail because its collapse could cause a domino effect, toppling other financial institutions. The Federal Reserve Bank of New York stepped in with an emergency loan of $85 billion to keep AIG afloat. In return, the government took nearly an 80% ownership stake in AIG, effectively making it a government-controlled company temporarily. This move was aimed at stabilizing the financial markets, which had frozen due to fear and uncertainty. Without AIG's support, many banks and investors could have faced massive losses, leading to even more failures and deepening the recession. The bailout helped restore some confidence, allowing AIG to sell assets and pay back the loans over time. In the end, taxpayers made a profit from the deal, but the rescue was controversial. It involved about $182 billion in public funds and raised questions about moral hazard, encouraging risky behavior because of the safety net. The AIG bailout showed how interconnected financial institutions had become and how a failure in one big company could trigger a major economic crisis. It highlighted the need for better regulation of complex financial products like credit default swaps, which had been largely unregulated before the crisis. The event also shaped future policies, like the Troubled Asset Relief Program, which was designed to help other struggling financial firms. Overall, the bailout played a key role in preventing a total collapse of the financial system. It helped contain the crisis and lessen the severity of the Great Recession. At the same time, it exposed weaknesses in the financial system that policymakers worked to fix afterward.